Well, we've just heard from the RBA, but what else is happening over in the States? So in a world of rising interest rates and the end of quantitative easing, where do you invest? For his thoughts, Stephen Glass from Pella Funds is joining us now live to tell us just that. Stephen, great to have you on the program this afternoon. But reaction to that RBA, does it change any investment decisions for you here locally?
No, well, we're global investors, so we're not really focused on the Australian market so much. But obviously, it has implications for the Aussie dollar, which does matter, and we do actively hedge a currency. Look, that hasn't actually had a material move. I think we all know the general direction that interest rates will be moving in. In the US, it is a very nuanced situation. Everyone knows that the Fed's going to raise interest rates. The real question is, it's going to be 3 rate hikes. It's going to be 4, and I think it's Goldman Sachs, so even now saying it's going to be 5 this year. At Pella, we think that is probably a bit too aggressive. We've seen well, first of all, the US economy and the global economy has come off the boil a bit. Yes, inflation is very high, but a lot of that, the real issue is it going to seep into labour inflation? And the market's generally saying companies are going to be forced to increase prices because of the increase in labour rates. But there's also an equally strong argument that companies have been over-earning US companies have been over-earning for a while now. Their ROEs at all-time highs. And if that is actually the case, there is actually real potential that they won't be able to pass on all the prices, and we're rather going to see some margin compression in the US. So just because labour prices are increasing, and they did increase 3%, I think it was last quarter, year on year, which is a meaningful increase for the labour cost labour cost growth rate. People are just saying we're going to have heaps, inflation's going to be sustained and the Fed might raise it 5 times. And we just think there's a lot of reasons they wouldn't. The Fed is also, they've demonstrated time and again, they are hypersensitive to markets. And we're not convinced markets could actually withstand a 5 points or 5 rate increases this year and quantitative tightening. So to sum it all up, we do think rates are going to increase. We think 5 rate hikes are likely to be more aggressive than what will actually happen. And we think it doesn't make sense to make one-way bets at the moment.